In July 2013, Detroit filed for bankruptcy. The city owed $18 billion it couldn't pay. Among the creditors were 20,000 retired city workers who had spent careers as police officers, firefighters, teachers, and municipal employees. They had been promised pensions, guaranteed monthly payments for life. The bankruptcy court ruled those promises could be broken. Pension payments were cut between 4.5% and 55% depending on the fund. People who had worked 30 years for the city, who had planned their entire retirement around those promised payments, watched their income disappear. Some lost their homes. Others went back to work in their 70s. The money they had been guaranteed simply didn't exist. In 2017, Puerto Rico defaulted on $74 billion in debt and another $49 billion in pension obligations. Over 300,000 retired government workers faced cuts to their pensions. The island's pension system was only 7% funded, meaning for every dollar owed to retirees, only 7 cents existed. The cuts were immediate and severe. Retirees who had been promised specific monthly payments saw them reduced by 10% to 30%. Many had no other income. The pension was supposed to be their security after decades of public service. That security vanished when the math caught up with the promises. In September 2022, the United Kingdom's pension system nearly collapsed in 4 days. Liability-driven investment strategies used by pension funds imploded when interest rates spiked. The funds faced £1.5 trillion in margin calls they couldn't meet. Had the Bank of England not intervened with emergency bond purchases, the entire UK pension system would have become insolvent, wiping out retirement savings for millions of British citizens. The crisis was contained barely, but it exposed how fragile the system had become. 3 different pension crises. 3 different places. But the same fundamental problem. Pension systems make promises that the mathematics say cannot be kept. People work for decades believing they'll receive guaranteed income in retirement, but the money to pay those promises doesn't exist. The funds are underfunded, the investments don't generate enough return, the demographics don't work, and eventually the math breaks. When it does, retirees who planned their entire lives around those promises discover they're holding worthless IOUs. This isn't a problem for the future. This is happening right now across America. Over 100 cities and multiple states are following the exact same pattern that destroyed Detroit's pensions and Puerto Rico's retirement system. The warning signs are identical. The mathematics are unsustainable, and approximately 50 million Americans are depending on pension promises that will not be kept. Let me show you exactly how pension systems collapse, why the crisis is accelerating, which cities and states are next, and why the promises made to millions of American workers are mathematically impossible to fulfill. Before we examine specific collapses, you need to understand how pension systems actually work and why they're structurally vulnerable. A defined benefit pension is a promise. An employer, usually a government, promises to pay a worker a specific monthly amount in retirement, typically based on years of service and final salary. If you work 30 years and your final salary is $60,000, you might be promised a pension of 50% of that salary, $30,000 annually, for the rest of your life. That's the promise. To fund that promise, the employer is supposed to contribute money to a pension fund during the employee's working years. That money gets invested in stocks, bonds, and other assets. The investments grow over time. When the employee retires, the fund uses the invested money and investment returns to pay the pension. In theory, If contributions are adequate and investments perform well, the system works indefinitely. In practice, almost every public pension system in America has deviated from this model in ways that guarantee eventual insolvency. The first problem is underfunding. Employers, especially state and local governments, don't contribute enough money to the pension funds. Why? Because contributing adequately means raising taxes or cutting services, both politically unpopular. So they contribute less than actuaries say is needed, creating a funding gap. The second problem is unrealistic return assumptions. Pension funds assume they'll earn 7% to 8% annual returns on investments. These assumptions allow them to contribute less now because they expect investment growth to make up the difference. But earning 7% to 8% consistently requires taking significant risk, and when markets decline, the funds lose massive amounts. The third problem is demographics. Pension systems were designed when people retired at 65 and died at 72. Now people retire at 60 and live to 85. They collect pensions for 25 years instead of 7. The system wasn't built for this. The fourth problem is political manipulation. Politicians increase pension benefits to win support from public employee unions without increasing contributions to pay for those benefits. They push the cost into the future when they'll no longer be in office. The result is a system where promises far exceed the money available to keep them. This creates what's called unfunded liability, the gap between what's been promised and what's been saved. Across all state and local pension systems in America, the unfunded liability exceeds $1.3 trillion using the fund's own optimistic assumptions. Using more realistic assumptions, the number is over $5 trillion. That's the whole. And it's growing because contributions remain inadequate. Investment returns fall short of assumptions, and more workers retire every year expecting to be paid. Now, let me show you exactly how this plays out when a pension system collapses. Detroit is the blueprint. In the decades before bankruptcy, Detroit's population fell from 1.8 million to 700,000. The tax base collapsed. Manufacturing jobs disappeared. The city still had pension obligations to workers from the prosperous years, but far fewer taxpayers to fund them. By 2013, Detroit's pension funds were between 50% and 60% funded. For every dollar owed to retirees, only 50 to 60 cents existed. The gap was approximately $3.5 billion. The city tried everything to avoid bankruptcy. They cut services. Police response times stretched to nearly an hour. Streetlights went dark. Parks became overgrown. But the pension payments were legally required, and they consumed an ever larger share of the shrinking budget. Eventually, there was no choice. In July 2013, Detroit filed for Chapter 9 bankruptcy, the largest municipal bankruptcy in American history. The bankruptcy judge had to decide which debts would be paid. Bondholders, banks, and pensioners all claimed they had priority. The judge ruled that pension benefits could be reduced. The cuts were devastating. Police and firefighter retirees saw pension cuts of 4.5%. General city employee retirees saw cuts between 20% and 55%, depending on their specific plan. Cost of living adjustments were eliminated. Healthcare benefits were slashed. A retiree who had been receiving $2,000 per month might see it reduced to $1,000. These were people in their 70s and 80s with no way to replace the lost income. Some had to sell their homes. Others relied on family or returned to work if they were physically able. The promises made over 30-year careers were broken because the money didn't exist. What makes Detroit critical to understand is that the city followed a predictable pattern, and that pattern is now visible in over 100 American cities. Stage 1 is excessive promises. During prosperous times, pension benefits were increased without adequate funding. Politicians promised generous retirements to win union support, but didn't set aside enough money to pay for them. Stage 2 is demographic and economic decline. Population falls, businesses leave, tax revenue declines, but pension obligations remain fixed. The city still owes money to retirees from when times were good, but has fewer taxpayers to collect from. Stage 3 is budget cannibalization. Pension costs consume an increasing percentage of the budget. Services get cut to make pension payments. This accelerates decline because worse services drive more people and businesses away. Stage 4 is investment shortfalls. Pension funds can't earn the 7% to 8% they assumed because they're forced to liquidate assets to make current payments. This locks in losses and reduces future returns. Stage 5 is the crisis point. The fund runs out of money to make full payments. The city faces a choice between defaulting on bonds or cutting pensions. Neither is legally or politically acceptable, so they delay until bankruptcy becomes inevitable. Stage 6 is bankruptcy and cuts. A judge decides which promises get broken. Retirees lose income they depended on. The pension system that was supposed to provide security becomes a cautionary tale. Detroit completed all 6 stages. And right now, dozens of American cities are in stages 3, 4, or 5. Puerto Rico followed the same pattern, but on a larger scale. The island's government expanded rapidly in the 1,970 seconds and 1,980 seconds, hiring tens of thousands of employees and promising generous pensions. At its peak, 30% of Puerto Rico's workforce was employed by the government. These workers were promised defined benefit pensions that would pay them for life after retirement. But Puerto Rico's economy never grew fast enough to support these promises. The population peaked in 2004 and then began declining as young people moved to the mainland seeking opportunities. By 2015, Puerto Rico's pension systems were catastrophically underfunded. The main retirement system was only 7% funded. This means that for every $100 owed to retirees, the fund had $7. The gap between promises and assets exceeded $49 billion. How did it get this bad? First, contributions were inadequate for decades. The government contributed far less than actuaries recommended because it didn't have the money. Second, benefits were increased multiple times without corresponding increases in funding. Third, the pension funds lent money to the Puerto Rico government itself to cover budget shortfalls. This meant the pension funds were owed money by the same government that owed money to the pension funds, a circular debt that guaranteed eventual collapse. In 2017, Puerto Rico defaulted. The island entered a bankruptcy-like process under federal oversight. A fiscal control board was appointed to restructure the debt. The board concluded that pension benefits had to be cut because there was no other way to make the math work. Over 300,000 retirees saw their pensions reduced. Some cuts were relatively modest at 10%. Others exceeded 30%. For retirees living on the island with limited other income, these cuts were devastating. Many were already struggling with a collapsing economy, failing infrastructure, and the aftermath of Hurricane Maria. The pension cuts pushed thousands into poverty. What's critical about Puerto Rico is that the crisis was predictable years in advance. By 2010, anyone looking at the numbers could see the system was unsustainable. The government was already borrowing to make pension payments. The unfunded liability was growing exponentially, but nothing was done because fixing it would have required either massive tax increases or immediate benefit cuts, both politically impossible. So the problem grew until it became a crisis that forced cuts far more severe than would have been necessary if addressed earlier. The United Kingdom's 2022 pension crisis followed a different mechanism but revealed the same underlying fragility. UK pension funds, managing approximately £1.5 trillion in assets, used a strategy called liability-driven investment. The strategy involves using derivatives to hedge against interest rate changes. It works fine in stable markets. But in September 2022, when the UK government announced unfunded tax cuts, bond markets panicked. Interest rates spiked. The derivatives used by pension funds suddenly required massive margin calls, demands for cash to cover potential losses. The pension funds didn't have the cash. They were forced to sell assets in a falling market to meet margin calls. This selling drove asset prices lower, which triggered more margin calls, creating a doom loop. Within 4 days, the situation became critical. If the Bank of England hadn't intervened with emergency bond purchases to stabilize the market, the pension funds would have been forced into fire sales that could have made them insolvent. Millions of British workers would have seen their retirement savings wiped out not through fraud or mismanagement, but through a leveraged investment strategy that worked until it didn't. The UK crisis was contained through government intervention, but it exposed how fragile even well-funded pension systems are when they rely on complex financial strategies and assume stable markets. More importantly, it showed that pension crises can unfold in days, not years. The workers whose pensions were at risk had no warning. 1 week the system seemed fine. 4 days later, it was on the brink of total collapse. Now let's examine where American pension systems stand in 2025 and which cities and states are following the Detroit and Puerto Rico pattern. The numbers are staggering. State and local pension systems across America have total liabilities of approximately $6 trillion. They have assets of roughly $4.7 trillion. That's a funding ratio of about 78%, meaning they have 78 cents for every dollar owed. But that's using the pension fund's own assumptions of 7% to 8% annual returns. If you use more realistic assumptions of 5% to 6% returns, which is more appropriate given current bond yields and stock valuations, the funding ratio drops to around 60%. The unfunded liability grows to over $5 trillion. But national averages mask the severity of the crisis in specific states. Illinois has the worst funded pension system in America, at roughly 40% funded. The state owes $144 billion more to retirees than it has saved. Annual pension costs consume 25% of the state's general revenue. Illinois can't raise taxes enough to close the gap without driving more businesses and residents away. It can't cut benefits without violating the state constitution. The state is trapped in an impossible situation that leads inevitably toward either a federal bailout or benefit cuts through bankruptcy. New Jersey is nearly as bad at 36% funded, with over $200 billion in unfunded liabilities. Kentucky is 43% funded. Connecticut is 47% funded. These states are in stage 4 of the collapse pattern. They're cutting services to make pension payments. They're borrowing to pay current benefits. Their pension funds are having to sell assets to meet payment obligations, which locks in losses. The trajectory is clear, and it points toward Detroit-style bankruptcy within the next 10 years unless something changes dramatically. The situation at the city level is even more acute. Chicago's pension funds are between 23% and 40% funded, depending on the specific fund. The city owes over $33 billion more than it has saved. Dallas is 68% funded but facing rapidly growing costs. Houston's funds are below 60%. Philadelphia is at 49%. These are major American cities with millions of residents. When their pension systems fail, the impact will be national, not local. The multi-employer pension plans, which cover workers in industries like trucking, construction, and retail, where employees work for multiple employers over their careers, are in even worse shape. Of the roughly 1,400 multi-employer plans, over 1,300 are underfunded. More than 100 are in critical condition, meaning they're projected to run out of money within the next 10 to 20 years. The Teamsters Central States Pension Fund, which covers over 400,000 participants, would have become insolvent in 2025 without a federal bailout. The bailout, part of the American Rescue Plan Act, provided temporary relief, but didn't solve the underlying problem. And then there's Social Security, the largest pension system in America covering over 65 million retirees. Social Security is not technically a pension in the same way state pensions are, but it functions as one for most Americans. Workers pay in during their careers and receive benefits in retirement. The problem is identical to traditional pensions. The trust fund is projected to be depleted by 2033. When that happens, incoming payroll taxes will only cover about 77% of promised benefits. This means either benefits get cut by 23%, or payroll taxes have to increase by nearly 30%, or the government has to borrow trillions to make up the difference. There's no politically viable solution. The fundamental problem is demographics. Social Security was designed when there were 16 workers for every retiree. Now there are 2.8 workers per retiree, and that ratio is falling. People are living longer and collecting benefits for more years. Fewer workers are paying in. The math doesn't work. Politicians on both sides acknowledge the problem, but refuse to address it because any solution, cutting benefits or raising taxes, is politically toxic. So the trust fund keeps depleting, and the crisis date gets closer. Here's what all these failing systems have in common. They all made promises during periods of economic growth that couldn't be sustained during normal times. They all underfunded the promises, contributing less than necessary and assuming investment returns would make up the difference. They all used optimistic assumptions about investment returns, demographic trends, and economic growth to make the numbers look better than reality. They all prioritized current spending over long-term obligations, giving themselves and current workers benefits while pushing costs into the future. And they all reached a point where the mathematics became impossible. The unfunded liabilities grew so large that no realistic combination of contribution increases or investment returns could close the gap. At that point, the only options are dramatic benefit cuts, tax increases so large they drive away the tax base, or bankruptcy. Detroit chose bankruptcy. Puerto Rico was forced into it. Illinois and New Jersey are heading toward one of these outcomes within the next decade. The pension crisis is accelerating because three trends are converging simultaneously. First, demographic pressure is intensifying. 10,000 baby boomers retire every day, and this will continue through 2030. Each retiree shifts from paying into the system to drawing from it. The ratio of workers to retirees keeps falling. Second, investment returns are disappointing. Pension funds assumed 7% to 8% returns, but many are earning only 5% to 6%. This shortfall compounds every year, increasing the unfunded liability. Third, Fiscal pressure on state and local governments is increasing. Federal pandemic aid has run out. Property tax revenues are declining in many areas as remote work reduces commercial real estate values. State and local governments have less money to contribute to pension funds even as the required contributions increase. These three trends create a death spiral. Insufficient contributions plus disappointing returns plus growing payment obligations equals exploding unfunded liabilities. As the unfunded liabilities grow, the required contributions increase, but governments can't afford them, so they contribute less than required, making the problem worse. Eventually, the fund starts paying out more than it takes in and has to sell assets to meet obligations. This locks in losses and reduces future returns, accelerating the decline. Let me show you what happens when the crisis hits. It won't be announced with headlines saying pensions are collapsing. It will start with seemingly manageable problems. A city will announce it needs to reduce pension contributions this year because of budget shortfalls. A state will lower its assumed return from 7.5% to 7% and announce the unfunded liability just increased by $10 billion. A pension fund will report returns below 5% for the third consecutive year. These will seem like isolated issues, technical problems that experts will fix. Then the cascade begins. A mid-sized city's pension fund runs out of money to make full payments. The city tries to issue bonds to cover the shortfall, but can't because credit rating agencies downgrade it to junk status. The city announces a 15% reduction in pension payments. Retirees sue. The case goes to state courts. While litigation proceeds, other cities in the same state realize they're on the same trajectory. They try to pass emergency legislation to reduce benefits for current retirees. Public employee unions organize massive protests. Work stoppages occur. Essential services are disrupted. Financial markets react. Municipal bonds from states with severe pension problems sell off, yields spike. This makes borrowing more expensive for these states, worsening their fiscal situation. More cities announce pension cuts. Retirees who had been receiving $3,000 per month see it drop to $2,000, $500, then $2,000. Those who can't absorb the loss sell homes and move in with family. Local businesses that depended on retiree spending suffer. The economic decline accelerates. Within a year, 5 to 10 cities have filed for bankruptcy protection. Within 2 years, a state with unfunded pension liabilities exceeding $100 billion faces a crisis. They can't borrow anymore because no one will lend to them at reasonable rates. They can't cut benefits without violating the state constitution. They can't raise taxes enough to close the gap. The state government effectively becomes insolvent. At this point, the federal government faces a decision: bail out the state and set a precedent that encourages other states to let their pensions fail or let the state collapse and watch millions of retirees lose benefits they worked 30 years to earn. Neither option is politically acceptable, but a choice must be made. If the federal government bails out failing state pensions, the cost will be trillions of dollars. This money will have to be borrowed, adding to federal debt, or printed, causing inflation. If the federal government refuses to bail out failing pensions, millions of Americans who spent careers in public service will see their retirement income disappear. Teachers, police officers, firefighters, municipal workers, all will learn that the guaranteed pensions they were promised don't exist. The social and political consequences will be severe. For individual Americans, understanding this crisis is essential for retirement planning. If you're a public employee with a pension, you need to evaluate the funding status of your specific pension fund. If it's below 70% funded, that pension is at risk. If your state or city has large unfunded liabilities and weak finances, the risk is higher. Assuming the pension will pay as promised is dangerous. You need backup plans. If you're a private sector worker depending on Social Security, understand that benefits will likely be cut or taxes will increase substantially. Planning retirement based on current Social Security formulas is unrealistic. The system will change, and change means less generous benefits. For everyone, the implications go beyond personal retirement. The pension crisis will reshape American society. Cities with failing pensions will have to cut services dramatically. Police, fire, schools, infrastructure, everything will be affected. Property values in these cities will decline as residents and businesses leave. The economic geography of America will shift away from places with unsustainable pension obligations toward places with better fiscal management. The crisis will also create massive generational conflict. Young workers will be asked to pay higher taxes to fund pensions for retirees, while knowing their own retirement benefits will be far less generous or non-existent. 3 pension crises. Detroit, Puerto Rico, United Kingdom. Each followed predictable patterns: excessive promises, inadequate funding, demographic pressure, investment shortfalls, and eventual collapse. The promises made to workers were broken because the mathematics made keeping them impossible. Right now, over 100 American cities and multiple states are following the same pattern. The warning signs are identical. The unfunded liabilities are staggering. And approximately 50 million Americans are depending on promises that cannot be kept. Maybe federal bailouts will prevent the worst outcomes. Maybe investment returns will exceed expectations and close the funding gaps. Maybe politicians will find the courage to make painful but necessary changes before crisis forces them. But Detroit thought something would save their pensions too. Puerto Rico believed the federal government wouldn't let them fail. The UK thought their sophisticated investment strategies made their pensions secure. They were all wrong. The mathematics eventually forces a reckoning. The pension crisis is not a future problem. It's unfolding right now. The systems are underfunded. The demographics are worsening. The fiscal pressure is intensifying. And the promises made to millions of workers will be broken because the money to keep them doesn't exist. Understanding this pattern is understanding the next decade of American economic and social life. The cities that fail first will be the warning. The question is whether anyone will heed it before the crisis becomes national. History suggests they won't. The pattern says we'll wait until collapse forces change. And by then, millions of Americans will have learned the hardest lesson about pension promises. They're only as good as the mathematics that supports them. And right now, the math says those promises will not be kept.